Today, we have a game-changing video that you absolutely cannot afford to miss. If you're thinking of investing in 2023, I'm about to reveal the one thing that will make all the difference between a profitable year and a potential financial disaster. But before we dive into the heart of this discussion, make sure to check out the description below. I've listed some of the best personal finance books that have personally helped me on my investment journey. And here's the exciting part. By using the link provided, not only will you gain invaluable insights from these books, but you'll also be supporting our channel directly, allowing us to keep bringing you more valuable content. So go ahead and click that link. We're going to discuss the power of data and research and how it can act as a powerful shield to protect your investments from market uncertainties. You'll learn how to leverage cutting-edge technology to your advantage, just like the pros do. So, if you're ready to revolutionize your investing game in 2023, smash that like button, hit subscribe, and let's embark on this transformative journey together. Don't forget to check out the description for those awesome finance books. Now, let's get started. The year 2023. During times of market slump and uncertainty, it's natural for investors to feel a sense of unease and seek safer investment options. Recent events, such as the failure of Silicon Valley Bank and the seizure of Signature Bank, have spooked investors, causing fluctuations in the stock market. However, it's essential to remember that market downturns are a part of the investment landscape, and knee-jerk reactions may not always be the best approach. Financial advisors emphasize the importance of staying the course during turbulent times. After experiencing brutal market results in the past, some investors may feel inclined to exit the market entirely. However, they firmly believe that those who stick with their investments through the ups and downs in 2023 will ultimately benefit from their patience. While acknowledging that the year ahead may be rocky, experts predict that 2023 will also present substantial opportunities for portfolio gains. The key is to weather the turbulence and stay invested. Investors who choose to ride out the storm can expect to see remarkable growth in their portfolios by the year's end. During these challenging periods, financial advisors like Stacey Francis engage in open conversations with their clients to provide reassurance and guidance. They remind clients that market volatility is a natural part of investing, and emotional decisions can often lead to unfavorable outcomes. Instead, they encourage clients to remain focused on their long-term investment goals and resist making impulsive decisions based on short-term market movements. Remember Warren Buffett's famous quote, "Be fearful when others are greedy, and greedy when others are fearful." Here are things that you should be cognizant of this year before investing. Avoid blind investing. Investing without a solid strategy or thorough research can lead to significant risks and financial pitfalls. Many unsuspecting investors fall into these traps, unaware of the consequences of their actions. Past financial crises serve as stark reminders of the potential dangers of blind investing. Take, for example, the 2008 financial crisis, where the subprime mortgage market collapse triggered a global economic downturn. Countless investors who lacked a well-thought-out investment plan saw their portfolios crumble as markets tumbled. Emotional decision-making and herd mentality are common contributors to financial losses. During periods of market volatility or euphoria, investors may make impulsive decisions based on fear or greed rather than rational analysis. They follow the crowd, even if it goes against their long-term goals, and end up bearing the brunt of collective mistakes. Acknowledge power of data and research. The thing that underpins successful investing is thorough research and data analysis. By delving into various sources of reliable data, financial news, and market trends, investors gain valuable insights that inform their decisions. Data-driven strategies have proven to be powerful tools in the investment world. Successful investors leverage quantitative and qualitative analysis to identify undervalued assets, recognize emerging trends, and forecast potential market movements. These data-driven approaches have produced remarkable success stories. Investors who take a disciplined approach to research, back their decisions with data, and avoid emotional biases have reaped substantial rewards in their investment journeys. Don't try to predict the market. Don't try to predict the market is sound advice from Wakefield Hare, CFP, and founder of Greater Than Financial in Kansas City, Missouri. The allure of attempting to forecast market movements can be enticing, even for seasoned professionals. However, it's a risky endeavor, especially with only a basic understanding of the complexities involved. Even experienced investors find it challenging to accurately predict market trends consistently. The market is influenced by a multitude of factors, including economic indicators, geopolitical events, and investor sentiment, making it highly unpredictable. Relying on hunches or gut feelings when making investment decisions can lead to significant financial losses. Instead of trying to time the market or picking individual stocks, a more prudent approach is to invest in diversified, low-cost funds. One such option is a total market index fund. These funds offer exposure to a broad range of stocks, providing instant diversification to your investment portfolio. By holding a mix of assets, the impact of any single stock's poor performance is mitigated by the potential gains from others, reducing overall risk. Total market index funds are passively managed, meaning they aim to replicate the performance of a specific benchmark index, such as the S&P 500, rather than relying on active investment strategies. This passive approach typically translates to lower fees compared to actively managed funds, which often have higher expense ratios. By investing in a diversified index fund, you can benefit from the overall growth of the market while minimizing the impact of individual stock fluctuations. This strategy aligns with a long-term investment outlook, emphasizing steady, sustainable growth rather than short-term speculation. Take a bird's-eye view. In today's fast-paced world, investors are bombarded with constant information and headlines from various sources, often designed to instill fear and panic. It's crucial for clients to remove emotions from their investment decisions and tune out the noise. Viewing investments as a marathon rather than a sprint can help curb the impulse to sell hastily during market downturns. Embracing a long-term perspective means recognizing that market fluctuations are natural and part of the investment journey. Even significant market dips may feel less daunting when you plan to stay invested for the long haul. By taking the long view, investors allow themselves time to weather the storm and recover from temporary setbacks. A key principle to remember is that money needed within the next 5 years should not be heavily invested in the stock market. Short-term financial goals, such as saving for a down payment on a house or funding an upcoming vacation, are better suited for safer options like online high-yield savings accounts. These accounts offer better interest rates and preserve capital, making them more suitable for short-term objectives. Make good use of employer matching dollars. One of the most valuable financial opportunities that should never be overlooked is taking advantage of employer matching dollars in retirement accounts. This advice, reiterated by Robert Stromberg, a certified financial planner and founder of Mountain River Financial in Jenkintown, Pennsylvania, holds true across various industries and income levels. Employer matching can significantly boost your retirement savings, and passing up on this benefit is like leaving free money on the table. Many companies offer a matching contribution to their employees' retirement plans, such as 401k or 403b accounts. Typically, the employer agrees to match a percentage of the employee's contributions, up to a certain limit. For example, if your employer matches 100% of your 401k contributions on up to 4% of your salary and you earn $50,000 a year, you have the opportunity to secure an additional $2,000 in contributions from your employer. If you contribute 4% of your salary, which amounts to $2,000, your company will also contribute an equal amount, making your total annual contribution $4,000. This employer match effectively doubles your retirement savings for that year. Failing to contribute enough to receive the full employer match means losing out on free money and an opportunity for significant growth in your retirement fund. Over time, these additional contributions can compound, resulting in substantial gains in your retirement account. However, it's important to be aware of your employer's specific matching policy and contribution limits. Some companies might match a different percentage of your contributions, while others may require you to contribute a certain percentage of your salary to receive the full match. Making the most of your employer's match is a smart financial move that can have a lasting impact on your retirement nest egg. It is essentially an additional form of compensation from your employer, and it comes with valuable tax benefits, as contributions to 401k and 403b accounts are usually made on a pre-tax basis. In short, by staying informed and taking a data-driven approach, you can navigate the unpredictable investment landscape with confidence, embrace the long view, tune out market noise, and focus on your long-term financial goals for a successful and rewarding investment journey. If you'd like to learn more about personal finance, click on the suggested video on the screen. Until next time, keep calm and compound on.